What happened at New York FinTech Week 2021? I'm going to answer those questions and give you three major takeaways from the conference in case you missed it. Are you interested in growing and scaling your business? Welcome to the Silicon Alley Podcast, where you'll hear from entrepreneurs, venture capitalists, and top performers on what it truly takes to grow and scale a business. You'll walk away with actionable insights you can apply in your own business and life. Now to William Glass, the CEO and co-founder of Ostrich, and your host of the Silicon Alley Podcast. Welcome. I'm William Glass, CEO and co-founder of Ostrich, and of course your host of Silicon Alley. Today I want to talk about some of the things that happened at New York FinTech Week 2021, which was October 19th, in case you missed it. There were some really awesome conversations, and a big shout out to the Empire Startups team, John Zanoff, and the whole Empire Startups team for putting together a wonderful event. So there were three themes that I really took away from the event that I want to touch on. One of them is in the crypto space and what's going on there. The second is with large financial institutions and how they are partnering with startups and thinking about investment and some of the challenges that they're going through. And then the third is around, are we in a fintech bubble? That was one of the names of the sessions, and by far it was one of the top sessions of the day. A lot of fun. So let's talk about one of the key takeaways in the crypto space from the conference. It was around regulation, which obviously is a tough topic or a welcome topic depending on where you are in the crypto space, but regulation. And one of the key things that was talked about during the panel that was really focused on, called New Kids on the Blockchain, clever title, is around regulation and specifically the opportunity that exists for regulators to get things right. So one of the things that we've seen as of to date, and this is being filmed October 20th, 2021, so we'll see how this ages, is that the current administration in the US is regulating through litigation. So they're filing lawsuits right now with players. And that's obviously not an effective way to help the entire industry, but regulators are really, really interested in learning about this. The challenge that they have is that even though there's some people that are really plugged in at the FDIC, SEC, or wherever, is that these are just massive organizations. So yeah, you might have a couple dozen people, maybe more, that are really invested, interested, learning, understand it. But then you've got, however many thousands of other people that don't. And so you've slowly moving a very large ship. But the opportunity that's really interesting that exists is that in Latin America, Africa, and in certain parts of South Asia, the global South, as it was referred to on the stage, there's this opportunity, one, because those places are more likely to give you kind of a banking charter so you can go out and start to do some of these different things and operate, but also there's this demand specifically for stable coins. So we can look at Bitcoin and Ethereum and some of these other coins and some of these other altcoins, but the stable coins are really interesting from the perspective that people are wanting to hedge against the local fluctuations with currencies. And there's this challenge that a lot of folks in the global South have gone through, where they've had a currency crisis. They've experienced these things firsthand and understand how important it is to have some sort of stable currency. And so the demand has always historically been for US dollars. And that hasn't changed. Now, when you think about stable coins, US dollars are already preferred. There's an opportunity for the United States to get regulation right. And that means specifically, and the term that was used was create this kind of new Marshall Plan, which I thought was really interesting. And the other thing that's interesting about this is that it's a pull. It's not the US pushing this on other countries. These are other people that are asking for some sort of stable coin tied to the US dollar, something that they can hold on to and be confident that it's going to hold value, and they can keep their money as soon as they're paid in local currency in the stable coin, and when they need to spend, they can pull it out in the local currency, and they don't have to worry about the fluctuation. So if there's hyperinflation, they're okay, and they're hedged. So that is really, really interesting, and that, again, this is a pull. So people are wanting this solution versus the US saying, here, let's do this. And the implications of that are that it could actually cement the US even further as the reserve currency. Whereas the narrative, from what I've been hearing, and again, I'm not the most plugged into this space, not the most educated, so take everything with a grain of salt, has been around, we want to replace the US dollar, or we can, use a decentralized currency and blah, 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 right? Okay, maybe, but there's an opportunity for a stable coin a CBDC. So a centralized currency that the Federal Reserve or someone put out. And there's also implications between monetary and fiscal policy that would have to be worked out through Congress, and it needs to go through the proper channels in order to be approved. But the benefits of that, when you think about COVID and trying to give stimulus to people, there's a delay from writing checks and, trying to change interest rates and do all these different things that have a hopeful impact. They affect borrowing and things like that. But the last thing that you need is if you lost a job to go out and borrow more money, even if it's cheaper to do so. Really, you just kind of need the cash. And so if we stimulate in different ways, and that was the conversation that was had, which, again, don't know what your politics are, but it's an interesting thought experiment to go through regardless, and to think about the potential use cases of a CBDC, a central bank digital currency, that could act as this sort of stable coin. So that was one of the key things on the crypto space. So the second is around the incumbent players. So Barclays was a sponsor, MasterCard's a sponsor, Citi was a sponsor, and there were other folks from other large financial institutions that were at New York FinTech Week. And they are interested, especially over the last 18, 24 months, with everything that's happened with COVID, of accelerating digital adoption and being able to reach audiences in a new way. We saw the rise of e-commerce that went from 6, 7, 8% adoption to 24% adoption or something throughout the pandemic. You saw that as well with digital banking. And they're looking for solutions and wanting to partner. So traditionally with neobanks and fintechs, it's been us versus them, us versus the incumbents, kind of the same thing in the crypto space. And we're starting to see less butting heads and more holding hands. And that's what's really interesting, because they're looking for these partnerships because they recognize that there's value working with fintechs that can be more agile, build better, and are more technology native. But there's also benefits from the fintech perspective of being able to work with an incumbent institution, partly because of how hard it is to get a banking charter. And there's also a ton of regulation that these big banks understand that startups, frankly, don't necessarily know or aren't aware of. And it's expensive to be compliant. And the big banks understand that. So this is really interesting because the big banks are looking for these partnerships. They also recognize that it still takes a long time. So you might talk to 1, 2, 3, 4 people in a company and think that you're kind of in the door, but really you need to talk to that 5th or 6th person that will find the right use case and help you actually get some sort of partnership, pilot, implementation in the door. So that's the other thing that's really interesting, is that the appetite is growing across all large financial institutions. And I would even say, based on the conversations, with some of the smaller ones as well. And the third highlight, which was a ton of fun, is FinTech in a bubble? And you've got to recognize that we are at a FinTech conference in New York with people that are bought in and invested in FinTech. And for the most part, everyone agreed that we are not in a bubble, though I think all of the VCs agree that the valuations have gotten ridiculous. And so from a bubble in terms of valuations, that's one way to define it. But even though the team that was arguing for FinTech is in a bubble made 2 interesting points. One, it's not necessarily a bad thing if FinTech's in a bubble. Not the same way that 2008 housing crisis, right? If FinTech's in a bubble, that's going to affect a smaller segment of the population. Most people will be fine. So they say that it's not necessarily a bad thing if a lot of these FinTech companies that aren't having a ton of success, getting crazy valuations with essentially no traction, no revenue, if some of those struggle and we kind of see a deflationary time in FinTech. But they all agreed. And then the second thing, and this is again with the team that was saying we are in a bubble, that the long-term value of FinTech is far, far from being recognized, and that the impact can be huge. So we might be in a short-term bubble, but the long-term is still an up and to the right kind of motion. And so there's a ton of value that can still be had from FinTech. And that was kind of the key takeaway. But I think most people in the audience are still bullish on FinTech and where we are, and don't believe that we're in a bubble, though some of the valuations have gotten crazy. And as a FinTech founder, I can tell you that one of the things that I'm thinking about is raising at valuations that are realistic, wanting to get a good valuation, but also recognizing that with a higher valuation comes higher expectations and being able to grow into those expectations. So there's a balancing act that you've got to think of. But the idea that the power has now kind of swinging away from VCs and investors to founders isn't necessarily a bad thing. It levels the playing field where now founders like myself can get to choose who they want to work with and really pick great partners versus just finding someone that will write them a check, which really should be the kind of baseline, right? There's so much more to the relationship than money. So those are the three takeaways. There was a ton more great conversations around all sorts of topics, but those are the things that really stood out to me. That's it. I'm William Glass, CEO and co-founder of Ostrich, and of course your host of Silicon Alley. Go ahead and subscribe if you haven't so you get more cool updates like this around tech, NFTs, entrepreneurship, all the cool things that you care about as someone in this ecosystem. And leave some comments. If there's anything that you learned or anything that you're interested in hearing more about, drop it in the comments. Would love to know. And check out Ostrich, getostrich.com, and hope you have a wonderful rest of the day.